Hey folks, going to get started. Obviously, the Powell press conference starts at the bottom of the hour. We'll talk through what the statement and the summary of economic projections looks like for the few minutes we have ahead. JP, you've got audio ready to go for the presser?
Hey, Rod. Yeah, got ready.
Volume's really low.
Oh, I haven't played it yet.
Oh,
Can you hear me?
your volume's not low. I just have my AirPods hooked up. Sorry about that. One sec.
Yeah.
All right, let me pin some things here, and I'll be live tweeting during the presser. We're going to play the audio through here, and then after the press conference concludes, we'll keep the spaces open and hopefully have a variety of folks join and kind of share their perspectives on what they heard. So that's the plan this afternoon. I'm going to just read a disclosure in a minute, as I must, and yeah, 15 minutes we'll kick off the audio, but let me pin a few things in the meantime. So yeah, I just shared both John authors at Bloomberg, and I picked up on the huge delta in the September summary of economic projections dot plot. So you can see the most recent shared tweet. I have both of those visuals, and you can see that the right-hand side, September, not one member of the FOMC had year-end 23 Fed funds rate above 5%, and now all but two. So just a huge shift upward from at least what the Fed is trying to message to markets about the Fed funds rate for 2023. And I think that's why equities have sold off initially on this. They were up almost 1% on the day before the news release. The NASDAQ is down about 60 basis points. So about 150-ish point swing intraday after the release. Obviously, we just got the SEPs and the statement. The Fed did do 50 basis points as the market had, I think, anticipated. The Fed Watch tool at CME had like an 80% chance priced in. I'm surprised it wasn't higher, frankly, given how much the Fed has talked about reducing the rate of increase. So it isn't a surprising move. I think just the big surprise again is the big uptick in the dot plot, and I think everyone expected it to tick up from September, but the magnitude of the move is pretty significant. So we'll be interested to hear what the chair says in 13 minutes when he kicks off. Joe, I got you up. I'm going to make you co-host as well. JP, just to confirm, we are good with audio?
Yep.
Okay.
That's good.
Cool. So yeah, we're not going to do our market open mic that we've been doing on Wednesday nights because, frankly, we find that when we do these intraday things, the participation at night and our energy levels at night are a little bit lower. So we're going to kind of combine our market open mic discussion on the tail end of this after we get done with Powell's press conference. So depending on participation, we could leave this open through or past 4 o'clock Eastern even. The press conference should run about a half hour. So depending on the interest and engagement level, we'll let the conversation around what the implications are, what people need to be looking at next, et cetera, run for an hour after we wrap Powell's prepared and Q&A remarks. Yeah, so in the meantime, though, I'm just going to get a disclaimer out of the way. Obviously, I'm hosting this under my personal account, but we, the Wook Capital team, are presenting this. So I do need to let everyone know that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay, with that mouthful out of the way, Aurelius requesting to come up. Hey. So you're muted. If you wanted to chime in, you can go ahead.
Are you talking to me?
Yep.
Oh, hey, what's up, man?
Hey.
So has Powell come out and said if they're going to raise 50 basis points, or are y'all still waiting?
Yeah, that came out at 2:00. The release. The tweet that I have pinned from myself is that thread. I'm going to be tweeting while we play the Powell audio through here. So I'm going to go on mute and I'll be tweeting, and you can kind of follow my.
So what did they raise? 50 basis?
Yeah.
Okay.
They,
cool.
they raised 50, which was expected, and they also made some adjustments to their economic projections that they had last published in September. So they marked down their estimate for GDP in 2023. So they're still forecasting a soft landing. They're still forecasting positive, below trend GDP growth of 0.5% for the full year of 23, which that plus really the change is the dot plot. What
is trend on? And I'm not an econ guy or much of a finance. What is the normal trend in terms of econ growth? Is that like 2% or?
Yeah, about that. So the long run that they call out, I think it's like 1 point. Is it 1.8? Yeah, 1.8 is the long run, and just the kind of basic economic principle behind that being productivity growth and population growth are the drivers of that in the long run. But yeah, they're calling for 1.8 by 25, so basically below trend growth next year and slightly below trend in 24 is their economic projection now, both of which came down, but mostly 23 went from 1.2 to 0.5. So, both below trend, which is what the chairman's talked about repeatedly, that they feel they need to, run the economy at below trend because they can only deal with demand and lower demand. They can't bring supply into the market.
Interesting. Cool. So, but you said something about being 0.5% below trend, but you're saying they're projecting that we'll be at 1.8% next year, or I got that a little mixed up.
Yeah. So it's I have the link. Let me just pin the links themselves up there. So the statement and the projections links are both pinned. The 2023 growth is projected at 0.5%. So.
Oh, I see.
Yeah.
I got you.
Yeah, they also ticked up their unemployment rate expectations slightly. Again, they're still forecasting that they can thread the needle and get a soft landing from this most recent forecast. So it'll be interesting to hear the chairman elaborate on what they're seeing and expecting in a few minutes here. Yeah.
Nice, man. Appreciate it.
Yeah. So again, just kind of recapping, for those maybe who just joined the room, the Fed released its statement at 2:00 and its economic projection updates. We're going to play Powell's audio at 2:30 when he runs his press conference. I will be live tweeting in the thread that I have pinned. I'll be tweeting below that kind of my, I guess, short form of what Powell's saying and the questions he's getting. Obviously, just listen to the audio here if you prefer. And then after that wraps, we will kind of open up the floor for anyone who wants to chime in, ask questions, opine, etc. With the plan to be keeping it open until at least 4:00, depending on engagement. So, yeah, if anybody wants to be a speaker, they're welcome to. Again, though, in 6 minutes here, we're gonna shut up and let the chairman speak. But again, the initial reaction is, it's a more hawkish, I think, message than the market's anticipated.
Yeah, I think so.
Yeah.
Well, dude, this is what I've been thinking. I got short long duration interest bonds about 3-4 days ago, And what I'm thinking is, even though, inflation's coming down, so everybody's like, yeah, okay, inflation's coming down, we can lower interest rates, we'll probably go into recession, yada, yada, yada. But you have this other group that's more like inflation's coming down and the economy is a lot stronger than people realize, which would be incentive for them to keep interest rates up, right? And it just kind of
Yeah, and
seems
some of the data points that support that latter view would be the strength in wage growth. And the
right.
chairman's been pretty consistent that, if you have wages growing at 5+%, that's not really commensurate with 2% inflation, which is their
So I'm thinking
mandate.
that the long duration bonds might have got ahead of themselves. If you've been watching the futures on those, I mean, they have just killed it over the past month and a half. And I'm thinking right here, at least that's how I'm positioning myself. I'm thinking we got to pull back the other day, but I'm thinking we get a little bit more. So I'm waiting to see how that kind of turns out. Could be wrong, and if I'm wrong, I'll get out of it, but I'm willing to make a little bet right here on that assumption. That's not financial advice. It's just me sharing what I'm doing. So
For sure. It's pretty much across the board too, from a factor perspective. Large cap value and growth are down equally, small cap in line with large cap. So pretty much everything down roughly the same. From a sector perspective, healthcare and staples are, well, the only ones about even on the day, and communications, materials, tech, discretionary stuff that you might expect to do weaker in a higher for longer interest rate regime or a weaker economy are the stuff lagging. So I think that informs kind of how the market's taking this news, at least that first reaction.
Well, about, I don't know, it was about 4 weeks ago, maybe 6 weeks ago, I was listening to this analyst talking about the correlation between bonds and stocks. And he was saying that this was the longest that bonds and stocks had both been under their 10-month moving averages and had a positive correlation like they did. And that there was only 2 or 3 times in history that bonds and stocks had this relationship, this positive correlation, and being this far below their 10-month moving average. So he was making the bet that bonds were going to end the year higher and that stocks were going to end lower because they were going to revert to that negative correlation that they do have. But it kind of feels like if bonds sell off right here, because I think that bonds and stocks are losing that correlation, we could see stocks maybe rally over the near term, possibly, and bonds give some back. Is what I'm thinking could possibly happen. Especially if people keep thinking man, the economy's whatever, people keep getting kind of high on this idea that the economy is just going to kill it, even though everybody's saying it's not. But yeah. What's your take on equities from here, Rod?
Yeah, I think things are still priced pretty favorably in equity markets. Equity markets are still pretty optimistic, it would seem to me, based on where rates are and where earnings seem like they'll be, to the point you made about, well, the consumer seems like they're holding up better than one would have expected. Not sure how durable that ends up being with savings rates where they are. And I think to an extent it becomes, once you start to see job losses tick up, which the Fed is explicitly telling you in their forecast that they expect to happen, and for them to explicitly call for that, I think is not normal. They wouldn't normally forecast that, but unemployment is trending below the long run projection that they have. Right, it's at 3.7 or whatever, and the long run forecast is 4%. But Powell's about to start speaking, so
Yeah, go ahead. I'm sorry.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a 0.5 percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year. But our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves. And many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Market reacting negatively to that last question.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, that we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation is coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE and core inflation index, is non-housing related core services. And that's really a function of the labor market largely. It's the biggest cost by far in that sector is labor. And we do see a very, very strong labor market. One where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. 0.5 percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about 0.5 percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But, what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And, that will allow us to feel our way and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report that had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting. And participants know that they know this, that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Rachel? Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the media, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby.
Thank you, Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down, I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil. Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
So you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline as long as new housing leases show declining inflation. That will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important. And we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael.
Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether in the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this. To the extent we need to keep rates higher and keep them there for longer, and inflation moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly lower inflation reports, were they to continue for a period of time, would increase the likelihood of a. So I would put it this way: of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of employment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control. And I believe we will. We're certainly highly committed to do that.
Grady. Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're gonna keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring?
We do. Yes, we absolutely do. We look at it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. Where you're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thanks, Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know and we see. But as I mentioned, we wouldn't, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that would mechanically happen like that. It'll be a test of for cutting rates. I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
Okay, guys and gals, I just posted my last tweet. If you look at the tweet I have pinned, you can kind of follow if you want to catch up with what the conversation was. I'm going to step aside for just a second. Need to use the restroom, and then I'll be back and we can keep the conversation going about what we heard from the chairman. Okay. Thanks again, folks, for tuning in. Now that we've concluded the Fed chairman's prepared remarks, I'm going to keep the spaces open through until 4:30. We'll see how much engagement and conversation we get. If anyone wants to come up, ask any questions, share any feedback on their side of things, I'll briefly summarize what I heard from the chairman. They're certainly happy with the data they've seen lately of inflation trending in the right direction. The pretty clear piece to me is that the chair's now a couple times broken down inflation into three major buckets. He's talked about goods inflation, which is rolled over. He's talked about housing, which, based on how it's calculated, it won't roll over until mid-23, but the leading data show rents are now declining on a month-over-month basis in many markets and at a national level. And then the third one, and the most important one, which is the majority, over 50% of the contribution to PCE, is the non-housing services. And you heard him pretty clearly note, I'm just trying to look through my notes here, he basically alluded to the average hourly earnings being really one of the most important metrics to monitor in the coming months. And he's been consistent about this for some time now, that you would expect to see the average hourly earnings levels become more in line with 2% inflation. And right now, running north of 5%, that's not in line with 2% inflation. So that would be the third piece of the inflation puzzle that the chair and other Fed members really want to see getting under control. So kind of monitoring those data over the next few months. He and the Fed in February will come out with a revised summary of economic projections, and he was quite clear that, look, the current economic projections that have them calling for the 5.1% Fed funds rate through the end of 2023 are based on the available data. And if the new data that come in over the coming months change, then that will change in either direction. So they're obviously trying to maintain optionality. There were a couple questions in there around, okay, you went down from 75 to 50 this time. Are you now, from Timmeros and from one of the other reporters, kind of the question of, okay, so now is the pace going to reduce to 25 basis points at the next meeting? He opted not to answer that. We kind of pointed to where the current projections have them getting to, and the need to incrementally tighten further in order to achieve the goals of getting inflation back to target. He also declined to answer. There was a question about will they raise their 2% target, and he said absolutely not something they're going to consider in the near term. So kind of tried to shelve that idea. He's pretty clear, and the question was, around will they cut rates in 23? And he said, I wouldn't see the committee cutting rates until we are confident inflation is moving down in a sustained way. So we're seeing some of that in the last couple months' data. So it will be interesting to monitor heading into the next meeting, how much has that wage inflation dissipated to give the Fed more confidence that they're on a path to get where they need to be from an inflation perspective. And there's still definitely disagreement in what's priced into the Fed funds futures. I saw while I was taking my notes that the market's pricing at least 50 basis points lower than that 5.1 the Fed is asserting they see. So the market still thinks there will be implicitly cuts. They must see that the incremental tightening that the Fed's calling for will loosen somewhat by year end 23. And that's obviously not the messaging the Fed has made, but as the chair's been pretty clear, it's a very uncertain environment, and they'll react to the incoming data. So, yeah, I would say on net, I'm just looking at markets. They've recovered most of their losses from when the statement came out. They're flattish now on the day. Volatility is down meaningfully, over 5% for the VIX index. So, as the market listened to the chair, it still has no fear. It seems no major concern. The Fed funds futures show the market still thinks that there will be easing sooner than the Fed says. And yeah, we'll see what happens. I do think, again, the most important, obviously, inflation to monitor, inflation data coming in, but really that average hourly earnings data, the Fed needs to see that that's starting to roll over and come down, and you're not in this environment where wages are increasing at a pace that's disconnected from that 2% inflation target that they are, of course, sticking to per their mandate. There were a couple questions in there kind of talking about the unemployment rate. So they did slightly raise the unemployment rate expectation, which, to me, I don't see it. So what I mean by that is, and I have it pinned, again, in either of the tweets of mine I have pinned, you can look at the SEP data. So they talk about GDP, right? They say that 2023, the expectation is 0.5% growth, which is down 70 basis points from September, which they'd projected 1.2%. Both are below trend, right? But the unemployment rate increase was only 0.2%. So they're still very reluctant to call for anything in that data set that's not a soft landing. I mean, clearly the forecast they're trying to put out is that they can get inflation under control by tightening to this extent, by keeping it this restrictive, without seeing a meaningful uptick in unemployment. I mean, if you see 4.6% unemployment by the end of next year, I think the Fed should be taking a victory lap, if so, because if you have unemployment just a hair above the long run estimate of normal, then they successfully navigated through this environment without really messing up the labor market. So it still seems pretty optimistic inherently what they have in their projections, to me at least. I'd love to hear if anyone has any differing opinions or thoughts. Dylan, I know you follow this closely. Love to hear your thinking on the matter, and anyone in the audience, who has any questions, you're welcome to put your hand up at any point and come up and chime in. So I'll pause there.
Hi, Rod. Hi. Hey, Rod, I appreciated you live tweeting. Your thumbs must be sore. No, I thought that was one of his better FOMC press conferences, and I felt like it was definitely a lot more genuine than, obviously he came out at the beginning with the, we understand inflation's too high. He's been saying that really since Jackson Hole, when he first came out. And, again, I guess it's good that he acknowledges it, but yeah, I really like what he said, but I don't think the market still believes him, which is, it's incredible. I mean, we had a very favorable CPI print I mean, extremely favorable CPI print on Tuesday. I mean, as I've been saying, the inflation story is it's really over, but prices are still elevated, and I'm kind of worried the fact that yields didn't blow out. I know that Davis is short long duration, and I was kind of wishing for him to make money, but the fact that the yields won't rise, it's very questionable. A lot of people think the yields are forecasting recession, whereas I think it's have a different explanation, but just puzzling to me the fact that the markets are still choosing to fight him. And yeah, I really don't think we're going to see rate cuts for another likely 10 months. And it's just going to be higher for longer because there's a huge difference between asset bubbles and the real economy. I saw his forecast on GDP, and that probably seems about right. I was actually beginning to think, and this is going to sound crazy, I was beginning to think, what happens if we see 4 negative GDP prints next year, which would be pretty toxic. But you'd have to look at what's making those prints negative. The most important thing is that the labor market remains strong, which I'm glad he addressed that issue, because everyone keeps talking about the labor market and how all these layoffs are going to happen. But I mean, companies are really holding on to their workers because they understand that, well, first, I guess, one, they maybe don't trust the forecast, and then two, as they did during COVID, they fired their workers only to hire them back at a higher price. Which again, if you're a worker, you're happy because you got a pay raise, a much needed pay raise. But if you're an employer, your labor expense went up 20 to 30%.
Yeah, the idea that, and I like to shout out the authors. I'm a big fan of following, I think, John Authors at Bloomberg. His Points of Return newsletter is something that everyone should get. And he included several different graphics of various ways to show CPI in his newsletter out last night. Let me look so that if I can pin it. Otherwise, I'll tweet the image myself. But the NFIB data, the National Federation of Independent Business, still shows the survey respondents seeing the jobs hard to fill beyond any point they've ever been. The percent of respondents net seeing that, and the price pressure level is still very high. So it's like that stuff, to your point of, are businesses going to hold on to employees because of how challenging it's been for so long to acquire them and get the needed people? You would maybe we'll see that to a greater extent than historically has been the case. And that would be good for, I think, what the chairman hopes to see pan out. It's just clear there's this supply-demand mismatch in labor markets. The Fed can't address the supply part. They got the question again today of, what should Congress do? And the chairman's not going to, explicitly tell Congress what to do. But it's clear that what he'd like to see would be some sort of an immigration policy reform that encourages net migration to increase to alleviate the shortfall. There's clearly demand for labor there. Whatever form that takes would be on Congress. And with the new incoming Congress, one would, I think, be skeptical that any sort of a major bill will get through to address that. So, given that there probably won't be anything addressing the labor shortfall, right? The people who passed away from COVID are dead. The people who retired don't presently have an interest in coming back. And the people who didn't come to this country because of the prior administration's policies, the effects of COVID, and lingering constraints placed by the current administration, those are things that the Fed can't solve. They don't have the tools to solve. They have this blunt force instrument that, if you would have told me that they'd come out with 5.1, all but 2 members of the committee above 5% for year end 23, trying to send that message, and that markets would, I guess they ticked down just a bit in the last few minutes, but basically be flattish on the day, I would have been surprised, right? So, super hard, I think, to try and trade any of this stuff. Even if you knew the data ahead of time, it's hard to know. This is sometimes how the market will react, right? Market's ticking down now. I don't know if there's any incremental news that's coming out.
So I was fairly certain that we were going to see a terminal rate. I wrote it in my Substack, and I've been tweeting about it for a while. I think I've probably talked to you. The terminal rate really wasn't a surprise. I know that some people are claiming to be surprised by it, but I really think that 5.25%, that's going to be the top. They're not going to go higher than that, and then it's just going to be a pause. But I really think the economy can handle the higher rates. I think a lot of people think that everything's just the whole world's going to break, and sure, some asset bubbles will pop, but
yeah, I think the people who think the economy can't handle the higher rates are addicted to the liquidity lottery and are just hoping that you get declines in interest rates so that their equity valuations increase into infinity again. I think if you look at the real economy, it's hard to disagree with what you just said, that the real economy could handle these rates and is handling these rates and has proven capable of handling these rates. And we're not seeing the employment picture fall to pieces. Inflation's solved in most cases, but for kind of this lingering supply-demand mismatch in services. And we'll see if that gets remedied in the coming months, if average hourly earnings start to return toward levels that would be in line with that policy goal. Clearly, he made it clear that they're not, this is where they stand at this point in time based on all the available data, right? They're going to update in February based on what comes in. And if you get more softer prints, then they may bring that terminal rate down slightly, right? If you see wages come down, average hourly earnings come down, I would expect that you can then see them thread that needle and achieve that soft landing, higher likelihood of that. But I think the challenge will be if those average hourly earnings continue to stay very elevated, then it's clear that the real economy is capable of handling incrementally higher rates, and that in order to achieve their target, that they would act accordingly. But obviously, that's all prognostication.
See, that's the one point where I'm on the other side. I want to see those average hourly earnings up, because right now, like year to date, if you're an hourly worker, you make your purchasing power is 2% less. So it's the equivalent of a 2% pay cut than in January 2022, and it's very hard to see economic growth with that numbers. There's another thing floating around FinTwit from the Philadelphia Fed that in Q1 there was 1.1 million net new jobs created in Q1, and then it's something like 1 million net new jobs created in Q2. Now that's Q2 of this year. Again, you hear that and you go, how is that not a healthy economy? I don't know. I'm sticking to the soft landing thesis, and I don't know if you heard Powell when he talked about it. He kind of there was some confidence in there when he talked about the soft landing. I really think we're going to get a soft landing. I think this is just completely overblown, or people are confusing asset bubbles with the economy.
Joe, JP, any thoughts? And anyone in the audience wants to chime in, again, don't be shy.
Yeah, I'll just add that there's going to be a point where market participants just stop caring. I think he's put it pretty bluntly, Powell, that rates are just going to keep going up, and he's not going to change his stance anytime soon. So there will be a point where the market, continues to do these little bull rallies in a bear market, and people just decide that it's not worth quitting.
I know we talked about it a little bit last night. Howard Marks had put out a memo yesterday, and we, in our book club, had talked about the most important thing, which is a collection of his memos. But the memo out yesterday talked about this sea change, and the sea change being that, in his view, we won't be returning to a zero interest rate world, and we'll be at this level where he called out 2 to 4%. But we'll be at this level where rates are positive, real rates are positive. The chairman said this, that he wants to see real rates positive along the entire curve, which, the TIPS market is, I guess, the proxy he uses. But regardless, that Mark sees opportunities in credit. And, obviously anyone who'd been heavily invested in bonds, long duration bonds in the beginning of the year, has had an unfortunate year, but from these levels, if you think that where rates are today, are maybe a little bit restrictive, maybe the Fed balances out, and maybe really by the end of 2023 2023, the market, is right in that it's pricing this 4.5%. That should yield pretty attractive opportunities in credit, and maybe forward returns for credit are more attractive now after the drawdown in price due to the rapid uptick in rate. So that's what he's kind of calling for in that memo. This changed environment from the very loose policy era of 09 to 21. So yeah, a lot of people kind of seeing some inflection points, I guess, some regime changes. I think of course whenever you're doing individual security analysis, it shouldn't overwhelmingly play a factor in your thinking on that individual security and its competitive advantages or landscape, et cetera. But we obviously talk about the macro stuff to an extent, and I think it's important to be cognizant of it. Last night we kind of talked about, it's like you maybe don't know where things are going to go, but you should take pulse of where you stand and how things feel based on different observable data points, credit spreads, earnings ratios, multiples, variety of different things. I won't rehash them all, but when I step back and I just look at where people still estimate that earnings will be, where those multiples are relative to the risk-free rates, I would say that Howard's probably right. There's probably more attractive opportunities from a risk-adjusted basis in credit right now than in equity markets at the high level. And that's weird, right? A lot of us listening are younger. We don't, maybe we're want to be only invested in equities, but I think that's probably a great learning for those of us, myself included, who aren't the strongest at analyzing credit securities and covenants and the like. That there's probably a better risk-adjusted return profile on some of those maybe than equities.
Yeah, I threw the Howard Marks memo up in the nest on the space. So if you go to the space screen, it's up there at the top. He released it was yesterday, and he said, "In my 53 years investing, I've seen a number of economic cycles, manias and panics, bubbles and crashes, but only 2 real sea changes. I think we may be in the midst of a third one today." And then I linked the full memo. So it's definitely worth reading. He gives a pretty fair view on the current macro climate, and his credibility says it all. So it's worth reading if you're an investor in the current market.
Thanks, Joe. And yeah, just to remind folks, we're not going to do our normal open mic tonight at 7. We're kind of combining that into this. I think a lot of the discussion would be on the same content anyway. I'm sure if some folks are working or not in a position, they can tune in, and hopefully they'll scope this out if they're interested. But yeah, this is being recorded. It'll be available for replay if anyone is interested. Yeah, I don't know what else to add. I think the most surprising part to me is just to see, an unemployment rate that's such a little increase.
You're right. It says you're muted now.
You know what? It was his Elon Musk tweets. I don't know if you've seen. He's been taking out all his critics. He took out Elon Jet Tracker, and he took out the high school kid who created it.
20-year-old kid creates the Twitter account that tracks Elon's jet based on public information. Elon doesn't quite like it, and he says in like a month ago in a tweet that he was going to keep it up because he's so in favor of free speech, and then he takes it down today. It does seem related to the owner was tweeting out internal Twitter DMs talking about his account that were leaked to him. So that's probably why he was kind of talking about it with shadow banned and providing some internal Twitter messages to prove that, which is probably against some sort of terms of use, leaking internal Twitter stuff. Although Elon's been doing it himself. So yeah.
Well, he banned the one short seller. I don't know what his name is, but it's like the little Japanese anime figure.
No, so yeah, I thought that too. Cubico, though, apparently self-deactivated. Correct. It wasn't a ban.
Okay, because I don't dare tweet at, like, there's a bunch of stuff I want to tweet at Elon Musk, but I don't dare do it because I value this Twitter account too much. I'm just staying off the radar.
Yeah, Adam with your burner. Don't let your main profile go down in flames because he made the rich, thin-skinned man angry.
Yeah, I'd be pretty upset if I was suspended with the username Toast. Definitely not getting that back if I lose it. But I threw Joe up as a speaker, Average Joe. Feel free to go ahead with whatever you wanted to add.
Hey, I wanted to know if this past week, I'm going to be cautious on the gold coming up this new year because of that, and as well, I think the dollar will be stronger than we've ever seen in our lifetime. You know, I'd say by April, and I do say that Powell has a big fight, and that's the consumer demand for China goods that he's going to have to fight to try to have control over the pricing, the CPI. So, and as well, I say COVID helped lean manufacturing in the must on. So I do see the dollar getting stronger, and I do see inflation staying at this percentage rate until first quarter of next year.
Not sure if you were breaking up a little bit for me on my end, Joe. I heard some of the comments. I don't know if there was a question in there. Sorry.
Yeah, the main thing is, why do you think we're going after, the Russian gold and coming up with this defensive bill targeting that gold? And it's going to hurt anyone that ships it, does any business with Russian gold. So I don't know. Not many people are aware of what happened this week.
Yeah, I'm not aware of what you're discussing, so I'm certain most of the folks listening probably are not. If you wanted to summarize it.
Yeah, the summary is that they're targeting the Russian gold, which they say is fueling the war for them. As far as money wise, and secondly, it's going to target anyone doing business with their gold as well as moving it. So that's the key thing, and we'll see why it in the future. Right now, that's a question.
Interesting. Thanks for sharing. Yeah, I know there's been all these kind of ongoing different discussions around price cap, and you got some countries like India buying Urals oil for $60 a barrel, whatever. Yeah, I don't know what the impact of Russian gold not being transactable. I mean, you would think that further constrains Russian access to international markets, but yeah, I don't know what that really looks like.
Do you think that makes the dollar even stronger? That's what I'm anticipating out of that, is that that just makes the dollar go up in value.
Yeah, I don't have enough information to really have a viewpoint on it, but I mean that intuitively seems right. But one kind of separate topic, but he was asked the question about the China reopening. Obviously, there's been a big shift in how they're addressing COVID from the previous COVID zero regime. There's clearly been some major changes in the last week or two, and he kind of demurred that he doesn't know if that is on net inflationary or deflationary. The question was from Steve Matthews at Bloomberg, and I'm inclined to believe that if yeah, it's going to probably be in fits and starts, right? Because you have a population that's been told by the state for multiple years that this is a very dangerous disease, and you'll probably have some reluctance to maybe return to full normal, whatever that normal is now. So maybe it doesn't go 0 to 60, right off the bat, the Chinese economy, but I have to think that a reopening is an inflationary event on net. So need to see how it pans out, but that would be that'd be another, I guess, factor going on that has changed in the last few weeks.
Didn't Biden just state that he's going to try to lessen some of the, as far as some of the things that he has tariffs on? He's going to from China. I think he's announced that today, that he's going to look over and see which ones he can remove.
I hadn't seen that headline. You said that there's news out today. Biden is going to be reducing Chinese import tariffs?
Yes, yeah, on a few of them. So I didn't see which ones, but he did say that he was going to look over and reduce some of the tariffs.
Yeah, I'm not sure. I hadn't seen that news yet. I know one thing that's become, and we talked a little bit about it on our last book and review on Friday when we were talking about like nearshoring and reshoring, but that you've got the CHIPS Act, right? You've got like this desire from U.S. and allies to reduce the exports of some of these technologies to China, reduce their access to them. At least from an Inflation Reduction Act perspective, you've got allies in Europe and Asia seeking to be, covered by the IRA's meaningful credits toward, manufacturing and the like. Right now, it's very U.S. centric, so we'll see how that pans out. But that is, I think, a theme, a longer term theme is continued reshoring and nearshoring of jobs that I actually see as inflationary, because you're going to reshore and nearshore to closer markets. You're going to have more resilient, shorter supply chains, but there's a cost, and the cost there is that labor will likely be higher. If you're doing that whether you're doing it stateside or if you're doing it south of the border, even so, it's still net costlier than it is having a very lean single source supply chain out of, say, China that's been fine tuned for a decade plus with all of your tier 1 and tier 2 and tier 3, depending who you are. If you're an automotive OE suppliers, when you rejigger these supply chains, it takes a long time to get all of the widgets that flow through to whatever it is you're producing. You want those to then be located local to your manufacturing facility or whatever. So that's another kind of big moving thing that is, Marx mentioned in his memo, right, that globalization was deflationary for many decades. And if we're seeing this shift away from globalization, that is inflationary. And while there's all these puts and takes on the transitory nature of kinked supply chains and demand bullwhips and the like, longer term, that seems to me like something that would put upward pressure on inflation. But we'll have to keep monitoring and all that. I guess to say that there's the transitory aspects of inflation, and then there's these structural changes that are also going on under the waves of all this noise.
Rod, the flip side to that is you get a much stronger economy, and this is really what populism is. And when you hear certain policies, like I see the Build Back Better as the equivalent of MAGA. When you look at it, when you take the politics out of it, it's the same thing. It's bringing jobs to America. I don't know if you saw the TSMC announcement. I mean, if you substituted out one president for another, it would be the same thing. So yes, there is going to be some inflationary pressures, but then it's going to make up for it with employment, because you're going to have to pay higher wages. You're not going to get away with paying what the wages that you could pay overseas. And I think it's more bullish on the economy, but there's certainly going to be some inflationary pressures. Or what it might translate to, and this is what I'm kind of thinking, it's going to translate to softer corporate profits, which, again, we're all shareholders in here, so that would certainly affect us, because it's essentially who's going to take less. Is the consumer going to pay more, or is the company going to make less? I tend to think there's going to be a balance, but it's going to largely be the company will just have to accept a lesser profit.
Yeah, we mentioned the incremental factory for TSMC on the Friday call, which is available on our YouTube. Joe does a nice job of cleaning up and putting the video file together. So we did talk about nearshoring. We definitely had some of that conversation last Friday. Just FYI for folks, we are going to have our final Wook and Review newsletter and broadcast this Friday of the year. And that'll be at the close on Friday. And it's going to be a bit of a recap and year in review. So we've got that coming out on Friday. You're right, though. So from a wages perspective, the worker is going to get paid more. So something has to give, right? You can't have record high margins in perpetuity. It seems like margins are near all-time highs still. across at least the S&P, and the consumer, again, with the savings rate close to all-time lows, while at an absolute level, things like consumer balance sheets are pretty solid still. There's clearly some segments of the consumer that's really struggling, and the chair brings this up every meeting, noting that the low-end consumer, the bottom quartile or quintile, whichever, they're taking it on the chin with the inflation, and yeah, I'm inclined to agree, Dylan, that corporate profit margins would take a little bit of a cut, and if so, then that could be healthier for the real economy and maybe less healthy for financial economy valuations. 5 minutes till the close, so I think if we keep the conversation going, we can keep this running for another 15 to 30, depending. Otherwise, we'll wrap soon. Just to kind of recap where things stand now, markets prior to the call were up, let's call it 80 basis points in the day. They kind of bounced around down from the statement release. They declined when the Fed chairman began speaking. They rallied kind of toward the end of his speech, but as of now, there's you got the S&P down about 0.5% on the day, NASDAQ down about 70 basis points. So about a 1.5% intraday decline from before the Fed, and VIX is down 5% on the day. So a little bit of volatility coming out of the market, a little bit of risk-off sentiment after we saw the Fed come out and say that they'll be holding rates higher for longer than they had in the September SEPs. Financials are now the weakest sector on the day, and then communications with healthcare, utilities, and staples about flat. So more interest rate sensitive stuff is lagging. Kind of your flight to safety stuff is holding up better. And yeah, markets still don't think the Fed will maintain rates. The Fed funds futures are still pricing that there will be cuts from the terminal level by year end 23. So the market still doesn't think the Fed will maintain those levels as long as the current SEPs imply, which if we continue to see positive data points from inflation, and I think if the Fed sees what it wants to see from wage growth dissipating somewhat, then that could entirely pan out. But yeah, anyone in the audience who had any questions, wanted to chime in, again, I did kind of live tweet the event, so in the 2 pins that I put up, if you wanted to kind of skim those and kind of catch up on what happened, you can, and that'll obviously be available here after we wrap the call. One of the things I guess I'll pose this aloud because I don't know the implication, but one of the things I've seen a couple of reports in the last couple of weeks from, I think it was Goldman and Morgan Stanley, kind of talking about how you have a lot of reduction in liquidity over the balance of this month and in the first quarter, and they were kind of calling for declining financial asset prices on the back of that. The chairman, in the prepared remarks, noted the balance sheet runoff. There weren't really questions about it in the Q&A. Let me just read the statement aloud. So they noted that in addition to so let me just read part of the statement. Obviously, they raised by 50 basis points. They raised the target range to 4.25% to 4.5% for the Fed funds rate. Quote, the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So here's the part. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in May. The committee is strongly committed to returning to 2%. So I guess what I'm saying is I don't hyper focus on this, but I've read some reporting that this continued balance sheet runoff, this quantitative tightening, this reduction in liquidity should serve to put downward pressure on financial asset prices in the near term. I don't know if anyone has any thoughts on that or wants to opine.
Rod, do you remember you're older than me, so of course you were a market participant in 2019, correct?
Yep.
I mean, were you buying assets in 2019? Because I
thought assets were grossly overvalued.
Okay, I was buying. I was working in finance, so everything required approval. I was very greedily buying assets in January of 2019, and they were still running QT, and they actually ran QT all the way until September 2019 when we had the repo crisis. I'm sure you remember that. We won't go into it, but that was QT was ran all the way until then, although they did reduce it they announced the reduction in March, and then the actual reduction came in May, and then they restarted QE4 in September 2019, but it was only for Treasury bills. But what Morgan Stanley and what Goldman's saying is if you would have listened to them back then and you would have not bought assets, all the way until September, you missed probably a 20% rally in the S&P, because in 2019 I think the S&P rallied like it was 33%, and I was actually able to outperform that year. I captured more than the entire move because I thought QT was a non-issue. I really think QT is a non-issue this year. I think it's more or less the rate hikes, and specifically it's investor psychology to the rate hikes. It's kind of like the Fed is the wizard behind the curtain, from Wizard of Oz, where they think it's this great voice, and then Toto goes and pulls the curtain, and they realize it's just a basic man, and the only reason the voice mattered, the Wizard of Oz mattered, is because people thought the Wizard of Oz mattered.
Yeah, I mean, I'm looking at median forward PEs for the S&P 500. So in late 19, they got up in excess of 18, and right now we're around that again. We're, at least from Refinitiv data that Ed Yardney's group publishes, the median forward PE for the S&P has risen such that it's back over 18, and that's the median. So if we look at the entire index, it's a little lower. You could go by that and say, okay, it's over 17, and yeah, that doesn't look so rich, over the preceding decade or so. But I also, that's where, like, just in the context of where rates are today versus then, and the uncertainty going forward, I don't know. I personally don't find the market very attractive from an equity perspective to increase allocations with levels where they are today. At least large caps. You could look at small caps and mid caps; those look a lot cheaper. Those obviously don't fall in the S&P 500, but yeah, I mean, every time I think things are really expensive, I've found that they get even more expensive, and then I'm even less inclined to allocate my capital. But it's been a rough decade for value investors.
I agree with you. I used to work for, they were financial advisors, but they were at heart, they were value guys. And they had bought so much of their core positions in post 2009. Like that's when they bought what later became FANG. They didn't know it at the time, but it ended up becoming FANG. And like I went through some of their original purchase prices for a client, and I looked at like what they were adding, and it was very hard for them to buy stocks because they were value guys. And it was one of those things where you kind of just had to bite your tongue. Like I would argue that equity prices have really been inflated since like late 2016, maybe mid 2016. But if you wouldn't have bought equities, you'd have missed out on a magnificent bull run. So you kind of just had to bite your tongue and say, yes, I know I'm overpaying, but this stock that's expensive is about to get even more expensive.
Oh, that's a slippery slope. Yeah, I'm not a fan of greater fool games, but you're right. You can play them and time them and get it right, then there's a lot of reward to be had. I mean, the counter to that is risk. Risk still feels very high given how high asset prices still are, because inherently, how high can your forward returns be if asset prices start out at a very high level? So no, it does not feel like there's been anything remotely close to a capitulation that you would expect if there had in fact been a bottom put in the market. And obviously, you could look at some stocks like Carvana and various SPACs that are down 90+%, but you then look at stuff that is only down teens or less, and it's like, has there really been a steep correction? S&P on a year to date is now down 16%. I mean, I know that the Dow technically exited the bear market, right? There's a lot of mixed signals. I mean, definitely there's great trading opportunities. I just don't know about if you were truly trying to make a multi-year investment, in the indices, if those are really attractive right now. I'd argue they're not.
Ryan, you're probably right. I owned Apple. I think it was at 500 billion, and I bought it at, just because that's when I had cash. When you get out of college and you finally have your first job and you have cash, and then I sold it at like $1 trillion, and that at the time that was revolutionary that we had $1 trillion company in Apple, and I remember thinking like, how much higher can this thing go? Like what, where's the upside on it? And then, again, like 18 months later, it was at $3 trillion. Or I think now it's at like 2.5, but it's like, wow, I missed almost a 2x. And, again, the thing with Apple, you could put size into Apple again, my Apple holdings was, at one point, it was easily my largest holding, probably at 40% of the portfolio, because it's one of those companies where I don't have to worry about, okay, there's an accounting issue, or there's a fraud issue, or there's IP theft. Whereas for a lot of small companies, you would never put 40% of your portfolio in one name because there's too much risk. So that's the only thing I like about it. But I fully understand your point, and you make a very valid point. We have gone quite wild, and I think that's one of the things that when you look at the equity market, that's one of the reasons I think the Fed can really hold rates higher, because if you look at the equity markets, things are still looking very bubbly. And I know everyone wants to think that they bought the bottom, but it's just like we can hold rates much higher. And again, if the bubbles don't deflate, they don't deflate, but there's no sudden urge that we have to cut rates because asset prices are so down. Because just as you said, the S&P is down 16% from all-time high. If you read into it, you would think we're at a 3,000 S&P. Or lower, and that the world is just coming to an end and there's 10% unemployment, when in reality, things are quite rosy.
And I just want to be honest with folks listening, since we talked about Apple, I have in my personal account significant put positions in Apple, in the QQQ, in SPY. We've been talking about them, so just to disclose that, the expiries are largely March and June, and they're out of the money. But yeah, I mean, that's kind of it. I see Apple meaningfully above pre-COVID levels, continuing to have these issues with its supply chain, and it's still trading at a very rich valuation, as if the growth will go on forever at very high levels. And I tend to think that these generals that haven't been shot yet are the ones that we need to see decline, like Costco, Apple. I mean, again, it's not to say these aren't great businesses. It's just to say that if Costco's at a 40 PE, and where are your forward returns, at least over a 5-year duration? It's kind of hard to pencil out great returns if you've had multiple expansion for many of these companies. Sure, some of them have come in, but it's like the multiples are still near all-time highs, blown out from post GFC. Look, the stuff got really cheap. Large caps got really cheap in like 2011, 2012. Relative to small and mid caps. Right now, large caps still feel very rich relative to small caps and mid caps. That's why my bias is that those large caps, those flights to safety plays, still have a lot of downside. And that's kind of, for me personally, again, I'm not talking about Wook, I'm talking about my personal account. That's how I'm hedging myself, because I am still long many of my small and mid cap investments that I view as multi-year investments, but I kind of expect more pain in the markets writ large, and I don't fool myself into thinking that my stocks are going to magically all be immune to that. But 410, So we've spent the best almost 2 hours, and we talked about the SEPs. We talked about and we played the Powell presser. Welcome anyone up who wants to get any kind of thoughts in. Otherwise, I'm going to wrap this room up, and the recording will be available. It looks like there's some other rooms going on for folks, but yeah, I'll let any final remarks, final thoughts before we wrap. Okay, well, I'm not seeing any hands go up, so I'm gonna wrap up the conversation. Again, thanks folks for tuning in. We're going to continue doing these different ad hoc broadcasts of interesting economic events like Fed press conferences, like we did 2 weeks back with the Fed at Brookings, where we live streamed the audio and then kind of have some discussion afterwards. You know, obviously Joe and I and JP up here and the hosts and co-hosts all work for Wook Capital Management. I read that disclaimer early on in the conversation, but we are working toward building a crowdsourced research kind of platform, investor platform that there's no cost to be a part of that. You can join our Discord if you want to be part of that conversation. You can click the link in my profile to go over to the Wook Capital handle and subscribe to our newsletters. We release those on a weekly basis. We're going to be pausing come holidays, as some of us, myself included, will be taking some vacation time, but we typically every Friday send out a little newsletter with some highlights, and we'll do a deep dive into at least one topic and host a call at the close on Fridays. We typically hold Wednesday open mic conversations at 7. We're going to skip that tonight since we hosted this open mic for the Fed, but we typically do those on a weekly basis. We last night hosted our second book club where we talked about Howard Marks' The Most Important Thing. So that replay is available on the @Wook Capital handle, and I know Joe's going to get it uploaded to our YouTube. Yeah, I'm going to have a survey out on Friday. Really, we're just trying to better understand the types of content we can put out that investors value and think is useful and adds value to their day. We're going to begin covering earnings calls, especially macroeconomically relevant companies. Think your mega caps and others, industrials, etc. Starting with fourth quarter 22. So coming into the new year, that's going to be something else that we'll be putting out. And yeah, look, I mean, the reason we're doing it is not to be altruistic, but we believe that if we share information and others share information with us, we can get nuanced perspectives, uncover different nuggets of knowledge that folks in the market might have missed. And it really all builds on our experience we had successfully invested in GameStop in 2020. That's where I met John, my CIO, my boss, who founded Wook. And yeah, a lot of good stuff I hope that we're doing, and we appreciate any feedback that folks share with us. So thanks, folks, for tuning into this broadcast of the Fed decision and conference. We certainly hope to catch you on Friday. And if not, we hope everyone has a great rest of their year and some happy holidays ahead of them. So cheers, everybody.